Well, one of the things that I wanted to cover, and I get this question a lot, is so if I have one of those accounts where I'm actually being charged a fee, to have somebody or some organization actually manage it, what's the impact of that on my earnings, on my gains, actually? And and so I wanted, and that's why I put this together. And I think, like I said, in most cases, as an investor, you don't have to be an active investor. You can actually be a passive investor and focus on just a few of the indexes and do really, really well. And if you want to add some activity to it, where maybe you want to also include some additional stocks as part of the portfolio, by all means, you can do that too. Okay. So there are lots of different ways, but what I want to show you is basically if you were just to be a passive investor and still, and still be within, let's say, an account where somebody is managing it and, they're focusing on being long-term investors and seeing what the impact would be. So I've chosen four different securities here, and they're all based on one's a commodity, which is gold. SPY is the S&P 500 index. It's, as an ETF security. I have IWM, which is the Russell 2000, again, as a security, ETF security, and I have QQQ, which is the NASDAQ 100. And if you look at what they were 20 years ago, their prices were, basically on the top. The initial price per share, it was 43 for gold, it was 119 for SPY, 62.9 for IWM, and 41.2 for QQQ. And if you look at the current prices today, their gold is at 355, SPY is at 666. 0.18, and you have IWM at 241.9, and then QQQ at 600. And if you look at the compounded average growth rate, I know over the last 20 years for each one of them, it was 11% for gold, 9% for SPY, 7% for IWM, and 14% for the NASDAQ, which is exceptional. And then I also included the dividend rates. And again, this is based on some of the more recent information, but obviously gold has no dividend. But if you look at the S&P 500, it's roughly 1.5. The Russell 2000, that's about 1%, and then the Nasdaq is about 0.5%. And let's say that you actually invested, let's say $50,000 20 years ago. And what is that today in today's value? Obviously, if you look at gold, it would be 412,000. Uh, SPY would be 364,000. IWM would be 230,000, and QQQ would be 788,000. So you would have done very well. And again, this is including two recessions, one major recession back in 2008, 2009, and you'd still do again exceptionally well. Gold obviously, which it doesn't, it's not perfectly correlated with the S&P 500 as well as the Russell and the Nasdaq. So it's actually you'd want to have some sort of portfolio where you'd have some gold and actually some of the other securities. And again, I'm just looking at these four. Um, the Nasdaq has done exceptionally well. I mean, it's incredible the run that it's had, obviously because of technology. And again, if you had just invested in that, you would have easily actually, as you can see, it was 41. Now it's back in 20 years ago, and then the price 600 now. So basically, it's turned over 12 times, over more than 12 times actually, which is incredible. Um, But if you were to be charged, 1.25%, which would be a management fee over the last 20 years, then your returns would have been a lot less. And as you can see in the column in the middle, again, the middle row, you're looking at 320,000 for gold, 283 for SPY, 179, 179,000 for IWM, and 613,000 for the Nasdaq, and the difference is around 22%. for each one of those. So you would have lost out on 22% of what you could have had. And that's a big, big difference. Okay. That 1.25% doesn't look like very much when you just look at it one year. But when you actually look at it over, a multitude of years, it adds up. And it has a dramatic impact on actually what you end up getting as far as the valuation that you should have gotten. And so again, that's basically almost a quarter of your value that you didn't get. And then let's say the last row that I have is, let's say you also, so besides the 50,000, let's say you also invested an additional 5,000 every year, on the follow-on years, not that initial year of the 50,000, but next year, the following year, you added 5,000 to it, and 5,000 every year from that point on. Obviously, the returns would have, the overall amounts that you would have gotten to are greater. And as you can see, um, I mean, gold would be 749,000. SPY would be 671,000. IWM would be 459,000. And then NASDAQ would have been 1.3 million, which is exceptional, obviously. But if you actually look at the amounts that you would have earned by including that 1.25%, obviously it's a lot less, as you can see. And it's not the 22% that you saw back when it was just the 5,000. It's a little bit less because, again, on the additional investments, you're not compounding that 1.25 over the same 20 years for each one of those $5,000 that you're adding to it. So it's a little bit less, but in total, again, if you look at just the S&P 500, 545,000 versus 671,000 is a big difference. Um, and I'm sure, just like everybody else, you would want the 671,000. And basically, so the point of this is that, there is a tax whenever you are having an account managed by somebody else. And depending on that percentage, it could be a heavy, heavy tax. And so it's really, really important that you, as an individual, go out and really manage your own account. And you don't have to be an active investor. You can be a passive investor where you just invest in the S&P 500 or maybe several indexes. It could be the S&P 500, the NASDAQ, it could be the Russell, it could also be some international ETFs that are focused on some of the international indexes. And so you could actually have some nice diversity um, and just let it ride. And again, you will make money. You will do well. You don't have to have somebody actually do that for you. And you can also add a few great stocks here and there, especially as you see fit, as you actually understand them and are actually very interested in them. You should be adding some individual companies like Microsoft, which has done very well over the last, 20 years. And there are others, obviously. And so again, and the key to point here is that again, focus, on actually doing your own investing. You can actually do very, very well on yourself, on your own. You don't have to have somebody actually telling you what to do. And especially if most of the time, if you just actually do passive investing, you can do very, very well. Because active investing is harder, and then most of the time people don't actually beat the indexes, especially the S&P 500. So again, just something to consider, and hopefully this was very informative. Thank you.